Hey there, and welcome to this explainer. Today, we are totally tearing down the way most beginners look at trading charts, and we're building up a completely new, highly strategic study plan. Look, if you're feeling frustrated because you've painstakingly memorized all those textbook candlestick patterns, but you're still getting chopped up and losing trades, you are in exactly the right place. We are moving way beyond rote memorization today to decode what the market is actually trying to tell you. Let's dive right in.
So here's our game plan for the day. First, we'll decode candlestick DNA. Then, look at 5 key reversal patterns. After that, we'll clarify some messy price action, run through the TAE trading checklist, and finish up with trade management and targets.
To set the stage, I absolutely love this quote from our source material. Picture this. You hand the keys to a Ferrari to a 13-year-old kid. I mean, sure, they have the tool, but are they going to go out and win a Formula One championship? No way. They just don't have the context to the fundamental knowledge to actually drive the thing. Well, it is the exact same for trading. Having all these indicators and candlestick patterns slapped on your screen is completely useless if you don't have the broader market context to drive them.
All right, Section 1, Decoding Candlestick DNA.
Before we can read the broader market, we really have to understand the micro-level tug-of-war happening every single second between buyers and sellers. Every candlestick shows 4 vital data points for a given session: the open, the high, the low, and the close. For a bullish candle, which is typically green, the crucial takeaway is that the price opened low and closed high. Basically, buyers were completely in control of that session. Conversely, the bearish candle, which is typically red, shows the exact opposite story. The open is at the top, and the sellers aggressively smash the price down to close lower.
But honestly, the really fascinating stuff happens outside of that colored body, the wicks. The wick-to-body relationship acts as the absolute DNA of market sentiment. If you see a tiny body but a massive wick sticking out, well, that tells a dramatic, highly visual story of price rejection. It means that at one point, price traveled all the way out there, but an immense, undeniable wave of buying or selling pressure forced it all the way back. It's your main visual cue of intense market pressure. It literally lets you know exactly where one side of the market said absolutely not.
Moving on to Section 2, 5 key reversal patterns. Okay, we really need to stop thinking of these as just random shapes to memorize. They are actually powerful psychological stories of momentum shifting. So let's quickly break down the meaning behind the 5 core reversal pairs. First, the engulfing pattern. This is where a candle's body completely covers the previous one, telling us the opposing side just stepped in on steroids and totally took over the momentum. Second, the hammer and shooting star. These are pure price rejection stories. A huge wick shows a sudden, violent reversal of highs or lows. Third, the dragonfly and gravestone doji. These are very similar to hammers, but the open and close are at the exact same level. This means indecision quickly turned into total, overwhelming rejection. Fourth, the morning and evening stars. Now this is a dramatic 3-part story. Complete control by one side, followed by a sudden equilibrium or indecision, and then the opposing side breaking that equilibrium to just totally seize control. Finally, tweezer tops and bottoms. The market hits the exact same level twice and rejects it both times. It's double the price rejection. These specific patterns serve as your high probability entry triggers because they show you the exact moment the tide turns.
All right, Section 3, Clarifying Messy Price Action.
Let's be real for a second. If you stare at a 1-hour chart, sometimes it doesn't look anything like those neat textbook patterns we just talked about. It just looks like chaotic, choppy noise, which is incredibly frustrating when you're trying to apply a study plan. But there's a crucial trick here: knowing how to filter that noise by combining multiple time frames. If you have 2 messy 1-hour candles, you can mathematically fuse them into a single clean 2-hour candle. It's super simple. Step 1, take the opening price of the first hour. Step 2, take the closing price of the second hour. Step 3, find the absolute highest high and lowest low across both hours. Suddenly, 2 confusing, indecisive candles merge into one clear, massive rejection wick. You are literally filtering out the market noise to reveal the true high-probability story hidden underneath.
Next step, Section 4, the TAE Trading Checklist. Right, so here's where most people fail. They see a hammer pattern and just blindly trade it in total isolation. And frankly, that is a guaranteed way to lose your money over the long run. You need the TAV verification checklist to separate gambling from actual strategic trading. You absolutely cannot enter a trade unless all 3 of these elements align. First, trend. Are you in a bull or bear market? You can use a 200-period moving average to quickly filter this. Only buy if the price is above it, only short if it's below. Second, area of value. You want to execute at logical levels where buying or selling pressure historically exists, like support, resistance, or a major trend line. Third, and only third, your entry trigger. This is where those 5 reversal patterns we just decoded actually come into play. They confirm the setup.
So how exactly do you find that area of value on a completely blank chart? Just follow a simple step-by-step walkthrough. First, zoom out. You need historical context, so load about 400 candles on your screen to see the big picture. Second, draw the most obvious levels. And here's a pro tip. If you have to squint and force a line to fit, it's not a real level. Keep it incredibly obvious. Third, adjust your line to get the maximum number of touches across the historical price action. Remember, support and resistance are dynamic, psychological zones, not perfectly thin, unbreakable glass lines.
Finally, Section 5, Trade Management and Targets.
Okay, so you found the trend, price hit your area of value, and a beautiful hammer triggered your entry. What now? Well, take the number 57. In one of our source examples, 57 was the value of the average true range, or ATR indicator. Now, ATR measures market volatility. It tells you how much the market is naturally swinging up and down at any given moment. Why does this matter? Because if you place your stop loss too tight, a totally normal, everyday market swing is going to violently knock you out of a brilliant trade before it ever even has a chance to work. So here is exactly how you survive that noise and manage the trade once the trigger is confirmed. Take your obvious stop-loss level and buffer it by subtracting that ATR value, like 57 pips or 57 cents, just to give your trade room to breathe. Crucially, once you know that wider stop-loss distance, you absolutely must calculate your position sizing. If your stop-loss is further away, you need to buy fewer shares or contracts. This specific guidance prevents overexposure per trade, ensuring you're still only risking a safe percentage of your total account. Never, ever overexpose yourself just because the stop is wider. Next up, always set your profit targets before the next obvious area of support or resistance. That way, you get paid before opposing forces even have a chance to step back in. Finally, if you're riding a massive trend, you can trail your stop loss using a 20-period moving average, exiting only when the price definitively closes past it.
Which brings us to a question I want you to really chew on after this explainer ends. Are you trading patterns, or are you trading the context? Think back to our 13-year-old with the Ferrari. The engulfing patterns, the rejection wicks, the dojis, those are just the keys. The TAE checklist, finding your areas of value, utilizing volatility buffers, and dialing in your position sizing, that is knowing how to expertly drive the car. You've got to start looking at the whole road, not just the steering wheel. Thanks so much for learning with me today, and I'll catch you in the next explainer.